Return on assets is a financial metric that assesses how effectively a company utilizes its assets to generate profit. This ratio measures the efficiency of a company in using its assets to produce earnings and provides insights into how well the assets are being managed to contribute to overall profitability. Unlike some other profitability ratios that focus on sales or equity, return on assets, ROA, considers the total assets of the company, giving a holistic view of asset efficiency. Return on assets ratio. The return on assets ratio is designed to evaluate how well a company uses its assets to achieve earnings. It is particularly valuable because it provides a comprehensive measure of how efficiently assets are employed to generate net income, reflecting the company's ability to convert asset investments into profits. This ratio is more inclusive than others that might only consider specific segments of a company's financial operations, such as sales or equity. To calculate the return on assets ratio, you divide the company's net income by its total assets. Net income is the profit left after all expenses, taxes, and interest have been deducted from total revenues. Total assets include everything the company owns that can be used to generate revenue, such as property, equipment, and inventory. The ratio is expressed as a percentage, indicating how much profit is earned for every dollar of assets. Example: consider a company with a net income of $500,000 and total assets of $5 million. To find the return on assets, you would divide $500,000 by $5 million. This results in a ratio of 0.10 or 10%. This means the company earns 10 cents for every dollar invested in assets. If the company improves its asset utilization or increases net income without additional asset investments, this ratio will increase, reflecting better performance. Low return on assets. A low return on assets ratio suggests that the company is not efficiently using its assets to generate profit. This can indicate various issues, such as overinvestment in assets that do not contribute to revenue, poor management of existing assets, or declining profitability. It can signal that the company might need to reassess its asset management strategies or improve operational efficiencies. High return on assets ratio. A high return on assets ratio indicates that the company is effectively using its assets to produce earnings. It shows strong operational efficiency and good asset management. Companies with high ROA ratios are generally able to convert a greater portion of their assets into profit, which often translates into better overall financial performance. However, it's essential to consider the industry context, as asset intensity can vary widely between sectors. How can companies optimize return on assets? Improve asset utilization. Enhance the efficiency of existing assets by streamlining operations, improving maintenance practices, and investing in technology that boosts productivity. Increase profit margins. Focus on strategies that improve profitability, such as increasing sales, reducing costs, or optimizing pricing strategies to boost net income relative to assets. Optimize asset investment. Ensure that new asset investments are carefully evaluated for their potential return and align with the company's strategic goals to avoid unnecessary expenditures. Key takeaways. Return on assets is a key indicator of how well a company uses its assets to generate profit. It provides a broad perspective on asset efficiency and management effectiveness. A higher ROA indicates better asset utilization and profitability, while a lower ROA suggests inefficiencies or challenges in converting assets into profit. To enhance ROA, companies should focus on improving asset use, boosting profit margins, and making strategic asset investments. Regularly monitoring and analyzing ROA can provide valuable insights into financial performance and operational effectiveness.